Welcome, everyone, to a special Swapcast edition of the Liberty Advisor Show. I'm Picciott, the Liberty Advisor, and we also have Kirk Chisholm, the host of the Money Tree podcast. For our Money Tree listeners, you're used to Kirk asking the question, but today the tables have turned, and I get to put Kirk in the hot seat and talk about a subject that is on a lot of people's mind, and that is the inflation-deflation debate. Now, I see Kirk has the Federal Reserve behind him, which is fitting because I'm actually about to head to the scene of the crime, Jekyll Island, Georgia, which is actually where JP Morgan's private estate was off the coast of Georgia, where the plan for the Federal Reserve was hatched, and I highly recommend people check out the book Creature from Jekyll Island to know more on that. But anyways, Kirk, right now, you get asked a lot about, with all the Fed's money printing that's going on to try to keep the economy afloat. Just what are some of your thoughts about inflation right now? Because we've got a lot of people right now who are saying that, because of the all the money printing that is going on, that it's definitely going to, in the short run, cause massive amounts of inflation. And what would you have to say to all of our listeners on the subject of inflation right now?
Yeah, and this is a question I get a lot, and I appreciate you asking me, Tim. And one of the reasons why we wanted to have this this interview is to really talk it through, because I think there's a lot of misinformation out here, and I wanted to have the backdrop be the Federal Reserve, because I think it's ironic we're talking about inflation and people don't really understand what inflation is. So I want to take a big step back and kind of talk about what inflation is. Inflation, basically, it's a change. Inflation or deflation, it's a change in prices. So a lot of people think, well, there's 3% inflation a year and that's normal. Well, it's not really normal. It has been normal for the last 70 years, but prior to that, it wasn't. There were periods where there was inflation, there were periods where there was deflation. If I remember correctly, I think the last time there was any deflation was outside of 2008 was somewhere like 1955. So it's being well managed. And, that's the Federal Reserve's job, as they claim, to, price stability. And, there's, I have a background in economics. And so in all my studies, every single professor I ever talked to said, oh, inflation's good and we need to have, normal inflation. And there's a lot of reasons for that, but I don't want to get too much in the weeds because I don't want to turn this into an economics class. What's really important is kind of the lens you should look at inflation. Most people look at inflation as they don't want their money to sit in cash, because cash is going to erode in value over time. So you need to invest it. That is the story that's beaten into every single person's head that's ever invested in the market. It comes from the gurus. It comes from the textbooks. Everybody has the same sentiment. You can't keep cash because it's going to lose value over time. Historically, that's been true. Historically, cash has lost value over time. And the reason is, if inflation is, let's say, 3%, and you have $100, next year, your $100 is going to be worth $97. I'm simplifying a lot, but that's basically what inflation means. That's why people feel like they don't want to have their money in cash, because it's going to lose value over time. Now, it doesn't actually happen that way. You don't actually end up with less money. What ends up happening is the goods and services you buy cost more. So if you spend $100 on your cable bill, next year it would be $103. Something along those lines. That's really how inflation works. Now, what I think is not talked about, and this is really the important part, is that inflation is not a constant. We think of it that way because it's talked about that way, but it's not a constant. It fluctuates. It goes up and down. There are millions and millions of buyers and sellers in the market, and they all make up a total aggregate of inflation. And it's not uniform. So think of it this way. If you own a chocolate bar, that chocolate has gone up pretty much at the rate of inflation for decades. It's just, that is actually one of the better markers of inflation, because chocolate has pretty much kept pace with inflation. Real estate is another one. Generally speaking, it has kept pace with inflation. If you remove the period from pretty much 2000 to 2015, or up to today, historically hundreds of years, it has kept up with inflation. So there are some pretty standard measures of inflation where things will keep track of what inflation is. But no one talks about deflation. You know why? Because it's bad. It's bad in the eyes of the people who talk about inflation. It's not actually bad, but it's bad in the context of today. We've had inflation for the past, let's say, 70 years consistently with really no serious bouts of deflation except for 2008 and actually right now. But generally speaking, there hasn't been. And what happens is you have this energy. The best way I can describe it, there was a good article put out in I want to say it was maybe 5 years ago by Nassim Taleb, and it was called "A Black Swan in Cairo," and it was in, I think it was the International Affairs magazine. But really, what it talked about when I was reading it, here's a guy who really focuses on tail risks, and tail risks are the big black swan events like 2008 or COVID. Those would be black swan events. They're huge events that people aren't really predicting, but they do happen. And what he talked about in the article was basically that there's this distribution curve of volatility. And I'm trying to not get too into the weeds, but the distribution of volatility is, most volatility is maybe like hypothetically plus or minus 0.5% a day on an index, right? Like, let's just say that is the most common volatility during a day. Now, there might be days where it's up or down 10%, but they may happen like once every 10 years. So there's a very low probability on a distribution curve that that's actually going to happen. Now, what Nassim talks about in his article is really what the Fed is trying to do is they're trying to push down the distribution curve. So if you think of it as like this curve, what the Fed is trying to do is take their finger and push it down and flatten it. So it's a more normal distribution curve. That's effectively what is happening. But instead of it being more normal, because, you know, the area beneath the distribution curve doesn't disappear, it goes somewhere. What'll happen is a normal distribution curve looks like this. The new one, when you push it down so it's more flat, is you get these big tail risks. So it look like more of like a W. And that's a real problem. And anybody who's been paying attention for the last 20 years will notice that we've had more and more of these events as time has gone on. And they seem to be happening quicker and quicker. I mean, 2008 happened. That was really bad. You had about a year to prepare for that. Then we had, I mean, look at the crisis we had this year. That happened in a few weeks. You know, you had 2015. That took I forget, it was about a month and a half. If you looked at 18 to 19, it took 3 months. So if you kind of look at these events, they're happening quicker and quicker. Instead of 9 months, it's 3 months. Instead of 3 months, it's happening in 3 weeks. So the problem is all of this volatility picks up, and I know we're talking about inflation, but I think it's really important to understand that a lot of us have assumptions. Our assumptions in many ways are that inflation is a constant, and it's constantly going to be 2 or 3% or whatever the Fed's telling everybody these days. They're thinking that that's normal. And there really is no normal. There's only what the Fed is trying to do. They're trying to create stability in interest rates. They're trying to create stability in the economy. You know, love them or hate them. Some people don't like the Fed. I know Tim's not a big fan. The reality is we're in a situation where we have to take the cards we're dealt. We can't just redesign a system today because we're already there. And the mistakes that have been made, in my opinion, and you can't go back in time. So the question is, what do you do now? And so I look at inflation, and inflation tends to be uniform, right? It tends to be, if you think about like the 80s and 90s, we had inflation. It fluctuated a little bit, but basically after the big, Volcker incident where he really killed inflation, once you kind of got to a point of normalcy, inflation was, there were some expectations. It was within a range. Now inflation keeps going down and down and down. And, inflation is not necessarily a constant. When inflation happens, things tend to be more consistent. when you have deflation, there's a lot less consistency. So if you think about a time where there was inflation, let's say like like the 90s, it was more consistent. Like there was not a lot of deflation going on. It was mostly inflation. Everything was going up in price. It didn't matter what it was. Everything was going up at different rates, but more or less everything was going up. In deflationary times, that's not how it works. In deflationary times, it tends to be less uniform. It tends to be all over the place. And I'll give you an example. So if you think about inflation, well, what is inflation? Well, the price of goods and services have risen, right? That's really the effect of inflation. So yeah, some goods and services have gone up. If you look at healthcare and education, they've gone up a lot, right? And you think, oh, there's huge inflation out there. No, healthcare and education prices have gone up a lot. That does not mean it's across the board. Not everybody is paying for college. Sure, everybody's paying for healthcare at one form or another, but the insurance is compensating it too. So let's not go down that rabbit hole. The point is that is going through high inflation. Now look at other things. Look at commodity prices. Commodity prices have not been experiencing high inflation. If anything, they've been going down in price over the years. And look at the last 10 years in commodity prices just across the board: corn, soy, pork bellies, you name it, lumber. If you look at all these commodities or metals, energy prices, if you look at them all, they're not uniform. But in general, prices have been going down over time. That is not the sign of inflation. That's a sign of deflation. Historically speaking, inflationary times, you should see a rise in commodity prices. And we haven't seen that. So deflationary times tend to be a little less uniform, and they tend to be more sporadic. So commodity prices have gone down. But you say, yeah, but I've been to the store and all the stuff I'm buying costs more. It may cost more. And that is another good or service, right? So the calculation of inflation or deflation is split up between all these goods and services as an aggregate in our society, and they come up with a number. Some people think that it's not an honest number or a good number. We're probably going to interview John Williams in Shadow Stats. He has a really good method of calculating inflation, and he thinks that they're also not being honestly distributed. But let's hold that aside for a minute. Let's just assume that they're accurate. I look at it, and we've been monitoring this for years, and I'm seeing deflation. I'm not seeing inflation. I am seeing inflation in certain areas, but it's not uniform. So if you think about it, let's look at stock prices. You say, well, yeah, but the stock market's going up. That is one of the areas that we're seeing inflation. We're seeing asset price inflation. Asset price inflation in real estate, in stock prices, that is happening. That makes us feel like there's inflation. And the Fed wants us to feel like there's inflation because it is a positive reinforcement loop. If you think there's inflation, you will cause more inflation. There's actually a theory of reflexivity by Karl Popper, who theorizes this. George Soros is a guy who actually talks about this a lot. Whether you like or hate George Soros, he is an intellectual, and he does have some interesting thoughts. So reflexivity is basically the idea that if you have inflation, people think you have inflation, thus creates more inflation. And the Fed is really good at this. It's more of like a psychological tool that they use to manipulate inflation. Deflation works the same way. If you think there's deflation, you're going to continue to act as if there's deflation. You're not going to spend your money. You're going to save it. You're going to keep it in cash. You're not going to invest it. That will cause more deflation. So there's a negative reinforcement loop that goes on there. Now, so if you look at what's happened, you have some goods and services going up. You have some goods and services staying flat or going down, like TVs, for instance. I just went and bought one and realized that you could pretty much get a wallpaper-sized TV, like an inch thick, 60 some odd inches for less than $1,000. And they're coming out with wallpaper TV that you can literally like roll up. It's just crazy stuff. There was a time where we'd be paying a few $1,000s for a big screen TV that weighed as much as a tank. And yet, even though the technology is advanced, the prices haven't changed. So technology frequently has this deflationary effect. And so if you're looking at inflation or deflation is not uniform. So that's really kind of my message. And the last piece, which is really the most important part, the goods and services is what's measured. But if you can't afford them, then what does inflation really mean? Now, what I mean by that is wages. So wages for the last 20 years have, they've gone up and down over that period, but they've more or less stagnated. So if you look at 20 years ago, we're pretty much where we were. We're a little bit ahead of where we were 20 years ago. But think about that. We've not had wage inflation, and this is real wage inflation. We've not had that for the last 20 years. If you look at stock prices, they're up significantly. Why have we not had wage inflation, but yet all these asset prices and goods and services are going up? My point is, it's not uniform, and you need to be aware of that, because at some point, if wages don't continue to go up, people only have a certain amount of money. And at that point, they spend less, and it kind of changes the cycle. So I'm going to stop, ranting here and give Tim a chance to ask some additional questions.
Well, you did great, making my job really easy over here. And obviously, I'm not a fan of the Federal Reserve, and anyone that's been following me in any context, for any time would know that, along with our friend George Soros that you mentioned as well. But I think one thing that's important for people to understand, I'll make a statement and kind of get to a question, is that how the system was designed, it really can't have deflation. Now, we had some, deflationary periods, after the Civil War, when there was no central banking. But then as, now we're in this period where we've had central banking since December 23rd, 1913. And now we're at this point where we have a central bank. And because the money is backed by debt, and because of now we have all these derivatives and other assets that are tied to the derivatives, that if you start seeing deflation, essentially what will happen is the entire system can collapse underneath its own weight, because there's more debt in the system than there is money. And so basically in a Federal Reserve system that is not federal, not reserving anything, that's another whole nother can of worms. If you have deflation, the whole system collapses underneath its own weight. And I think eventually in the long run, we can have some massive inflation, and it can be in different, different areas. Particularly, we've seen, you mentioned, asset price inflation is where we've, particularly seen it. You'd also brought up John Williams' shadow stats. And I think it's important to note that a lot of these inflation numbers are definitely rigged, and in terms of ways that and that's probably kind of like outside the scope of what we want to talk about. But let's say you used to go to the store and buy cereal that was, I don't know, like 16 ounces, and now it might be 15. And so they can keep the price the same, but there's ways to do that, or they do things where they substitute, where you used to buy steak and now you buy hot dogs, and so they put the price of the hot dog in versus the price of the steak. Or and I don't know what the price of these things are, but let's say you had an iPhone 7 and it was $500, and now you have whatever the new iPhone is called. I don't know the iPhone, but it's like the XLR or X. Yeah. Well, no, I think we're beyond 8 now. I think it's like
we're at
iPhone
10
Pro.
Yeah.
And so now let's say the new iPhone's $1,200, but so it costs double. However, because it has more features into it, now by how they calculate these things, they'll actually say there's not inflation, because there's, let's say it's 5 times more powerful, or more memory, more RAM, everything else, yada, yada, yada. So now it's actually, they're, by how it's measured, it's actually, going down. And then it also used to be where the definition of inflation used to actually be money printing. And then somewhere along the lines, that definition did get changed. I did want to ask you different ways they measure inflation, but you had mentioned chocolate and real estate, how that was a good way to keep up with things. And really, what about and for people that are worried about inflation, what would you say some, good, hedges out there might be? Well, besides, I'm in Phoenix, so I just can't buy, a huge amount of chocolate. It would cost, a ton to, try to keep that baby air conditioned. But what's a good, hedge? I hear a lot of people talk about gold. Some people might even talk about Bitcoin. But what are some of the hedges that you see out there that could help protect people against inflation?
Let me actually make a point. You were talking about, I wanted to raise this point because I think it's really important. A lot of people think that money printing equals inflation. This is a common misperception. Now, everybody talks about this, even the experts, even the people in some of the typical hedges like the gold space. Everybody says, if you look back in 2008, where they printed, it was really the first time where they just kind of blew the numbers out and really printed a ton of money to save the financial system. And people thought, and they've been thinking this for the last 12 years, oh my God, there's going to be a huge amount of inflation. We're going to have hyperinflation, invest in gold. It's just going to be crazy. Everything's going to go through the roof and the system's going to collapse. All right, 12 years later, when has any of that happened? Is the dollar still a thing? Yep, people are still using the dollar. Is gold through the roof? It's higher, but it's not through the roof. Has society collapsed? No. So it makes for great.
Well, depending on which U.S. city I guess you're in right now.
That's true.
Maybe dictate that. So.
That's true. We'll take those aside. But if you really look at how things work, what I think most people miss is they think money printing equals inflation, and theoretically that is true. However, in practice, it's not necessarily true. So think about it this way. Let's take an example. Let's say you have $1 million in currency in our society. Let's just say $1 million. That's how much is out there. All right, so you got $1 million. That's the money supply. That's the amount of money in circulation. Let's say you go up and, all right, I'm just going to print up $1 trillion, right? You're just going to blow the numbers out and just go from 1 million to 1 trillion. That's huge inflation. That's like thousands of percent inflation, or 1000x, okay? You would imagine that prices would go up 1,000 times or whatever that is. I'm sorry, it'd be more like, let's see, this goes from 1 million to 1 billion. So it's going up like 1,000 times, right? That's not going to affect prices necessarily in the way that you think. Now, if you just dump all that money on the streets and people buy it and they start spending it and it is actually currency in society and it's floating around, then yes, you will find.
Let's not give the Fed any ideas, Kirk. You're standing.
Oh, they already have the ideas, Tim. Yeah. I could just way it back here, and just listen to what I'm saying. Or just please don't, actually. But no, Bernanke talked about helicopter money a while back, and so they're not unaware of
those are rookie moves now. Now they're talking about bringing in the stealth B-2 bombers now. So we've graduated from helicopters. That was that's not enough. Now we got to bring in the B-2 bombers. I'm sure.
Where's your money gun, Tim? You don't have that for this show? You don't have your money bazooka?
I actually use this so much that I ran out of batteries, and so I did. My daughters wanted to use them, and so I ended up buying a second money gun. But I do somewhere have a Trump money gun over there, but it ran out of batteries because we've had so much money printing that I couldn't keep up with it.
So let's get back to the point, because I think this is an important point. If you hear nothing else from this conversation, this is the point you really need to understand. Money printing does not equal inflation. So in that scenario I gave you, they print up another $1 billion, and they stick that $1 billion in a bank vault, and it just sits there. No one sees it. No one touches it. Technically, you've got $1 billion plus 1 million as your currency. That is what's in circulation. But the billion is not actually circulating. So you're not getting inflation. I mean, think about it logically, right? Like, that money is not circulating. You could have $100 quadrillion in a bank vault. If nobody sees it, it's not inflation because it's not actually in the system. So what I think you need to recognize is that just because they say they're printing money doesn't mean they're actually printing money. And what I mean by that is, people take money and then they just squirrel it away, or they have assets that are not being used. Or, as an example, the perfect example is the Fed buys assets. So the Fed buys assets. It's pretty much, we're not going to mince words here, Tim, because I know you would disagree with some of this, but I'm just talking like high level. The Fed is, let's say, an arm of the government, right? The government, they're printing money in one hand and then they're putting it in their other pocket, and it doesn't go anywhere. It's in one pocket or it's in the other pocket. It doesn't really matter. So my point is, it's not causing inflation. And people get this wrong. They think the dollar is going to go to zero. It's going to collapse because there's so much money. It's not all circulating. And a great example, and hopefully Tim can kind of punch in some of these charts, but if you look at the velocity of money, and for those of you who are not familiar with the velocity of money, it's basically the amount of money the number of times money circulates into society. So if there's a $10 bill and I give it to Tim for, I don't know, for whatever, for his mic. And then he takes that $10 and he spends it on an ice cream cone, and the ice cream cone guy spends it on a waffle maker. Like, there's circulation. There's like 4 or 5 people in that circulation. That means that money's circulating. If you look at the velocity of money, even though the Fed printed a huge amount of money, it's just dropped like a stone. The velocity of money has tanked, and it's been going down for the last, 20 years. It has not been making progress. So the time I would worry about inflation is actually if the velocity of money, there we go. Yeah, since pretty much 98 or somewhere thereabouts, it's pretty much gone down. So if you look at the velocity of money, that is an indication that the money printing is not actually having any effect. Because the velocity of money, and I don't want to get into the technical terms, but basically the velocity of money is an indicator. So if you're printing this money and effectively sticking it in a bank vault, which is what is shown there on the velocity of money chart, then you're not getting the inflation that you think. So even though they're printing money, it's not actually happening. Now, I would surmise that the Fed is doing this in a way to psychologically tell people we're having inflation. And if they wanted to actually get inflation, all they have to do is lend money to people, which actually has been floated as a trial balloon recently. And right now, money is actually created through banks. And if you don't know that,
if they just got rid of all taxation and then just let the money, and then let us keep all of our money, and then we'd spend more of it. I think that'd be a better way to do it. But anyway, sorry.
Yeah, I mean, that's certainly an idea that people have floated. And I think that, right now, if you're not aware, money is not actually created by the Fed, it's created by banks. Banks loan money to individuals. People take those money, they put it back in the bank, and they use it. And money is, and this gets into the technical, so I don't want to get into the weeds too much, but basically the banks are what creates money, not the Fed. And the banks are not lending. And if they're not lending, they're not creating more money in society, hence there's no inflation. So there's a lot of reasons that there isn't inflation. But the people who kind of get a bug in your ear because they think, oh, printing money equals inflation, deflation is actually a bigger problem. And I say this because deflation is what they're trying to keep away from. And deflation is what I've been seeing for the last 10, 12 years is heavy deflation. Now think of it this way. If the market sells off 35% and you know that we're basically going to become Japan, which we can talk about later, you're going to print a huge amount of money to get us out of that hole, right? And that's basically what the Fed has done, is they've quote unquote printed money to get us out of this hole with the market. And it's done that, but all they did was fill a hole. They didn't make progress. They just filled in the hole that was emptied out from the COVID crisis and the fact that people couldn't work for a few months. So that's really what they did. They didn't cause inflation. They just filled a gap. And so if you look at this moving forward, all they're really doing is keeping us afloat. They're not really causing inflation. What I would worry about, and if you look at historically, deflation is a precursor to hyperinflation. So if you think we have inflation, you think we're going to get hyperinflation, that's not how it works. What happens is we have inflation, then we have deflation for long periods of time, like Japan, they're a good example, and then you'd have hyperinflation. And hyperinflation happens quickly. It's not overnight, but it happens relatively quickly. And that's when you get worried. But we have a long way to go before we get there because we are the world's reserve currency. So I am not at all worried about inflation right now. Not in the least. I'm more worried about deflation, but given the Fed's stance on deflation, at the moment, I'm not worried about it. I do think that at some point, they're going to run out of ammunition, and that's going to cause a problem. And Tim and I were talking about this before. There might be a quote-unquote debt jubilee, as people have been talking about. I wrote about this in a paper in 2008. I actually wrote a letter to the Fed about what they could do to get rid of all the bad debt, and was talking about basically a debt jubilee. Now, that has actually been floated in the last 5 or so years as an option, which I think will have to be an outcome at some point. But for now, what I think people should worry about, and getting back to Tim's actual question, is, what can you do? What can you do now that inflation is a problem? Or deflation's a problem? Like, how do you invest for times like this? Because I think everyone's a little concerned that the market is, it's kind of on its ear at this point. You have the election coming up. You've got, basically, high unemployment. A lot of business, industries are not doing very well, but then you've got some industries doing very well. What I would say is, here's how you invest for different time periods. What works well in inflationary periods typically are commodities, stocks, real estate, and any pretty much cash flowing asset. Gold does reasonably well in inflation, but what doesn't do well in inflation are cash, bonds. Not all bonds, but bonds in general lose value over time because they're fixed. They're not growing with inflation where they should be growing. So over time they lose value. The interest rate is what offsets that. So, bonds aren't necessarily a bad thing. They're just, you have to watch out for that in inflationary periods. Now, if you flip the script to deflation, what works well in deflationary periods? Not much. Cash does really well in deflationary periods. Any asset that has a very strong, solid cash flow, bonds, and not every bond, but like a U.S. Treasury bond, something that's really, really solid that you can count on. It's not going to go out of business. Things like that will do really well in deflation. Because if you think about it, if you have a 20-year 3% CD, and now CDs are less than 1%, 3% is looking pretty good. No matter how, even if we get to negative interest rates and we have deflation, things are bad, you're still getting 3%. That's pretty good, right? Now, you have to think about, so in deflationary times, those things do well. Gold actually is one of those assets that is, it actually can do well in deflation and inflation. There's actually more to it. I know people think that naturally inflation is good for gold and deflation is not good. It's actually not that simple. Gold tends to trend well based on other factors, but in the simplistic term, gold is more of a chaos hedge, and it depends on how people are looking at it. So we can get into that later, but the point is what doesn't do well in deflation are leveraged assets. So real estate. So if you own a piece of real estate and you have 80-20 mortgage, that's a problem, because over time, and this is the inverse of inflation. Inflation means your cash is going to deteriorate over time. Deflation means your cash is actually going to go up in price over time. Your cash is more valuable. And it's more valuable because everything else is losing value. So if you think about taking out a mortgage as an example, right? Let's say you buy real estate. You buy a piece of real estate for $100,000, and next you have 5% deflation as an example. Next year it's worth $95,000. You're thinking, well, what the heck? Why is my real estate going down? Well, you had a $100,000 property. Your mortgage was $80,000 on an 80-20, right? So you have $80,000 mortgage. Let's say for this example, it's still worth $80,000, right? After a year, your property is not worth $100, it's worth $95. So your mortgage has not gone down in value, but your real estate has. Let's take a few more years. Let's say it's down 20%. Now you're close to underwater, right? All your equity disappeared because the price of real estate's gone down, but your mortgage has not gone down in price. It is a fixed asset. So the principal value has not changed. And I'm obviously in this example not counting the fact that you can pay it down. Assuming that you're not paying it down, your mortgage has not changed in principal value. So think about that for a minute. In inflation, it's the reverse. It's great to have leverage in inflation because your mortgage will depreciate in price over time. Not only are you paying it back, but the value of it goes down over time. So it's one of the reasons why so many people are interested in real estate is because you're getting a high amount of leverage on both the property as well as on inflation. So that's why real estate's great in inflationary times.
And you get to claim depreciation even while your asset's appreciating. Like, that's how, the quick version of how Donald Trump ends up with a $750 tax bill. But, that's a whole nother can of worms we're not going to get into right now. So,
yeah, no, it's an important point. And so real estate's a great asset during inflationary times. In deflationary times, it's a terrible asset to own. It's actually, let me rephrase that. It's not a terrible asset to own. The reasons that you own it in inflation are reversed. So if you look at Japan's a great case study because it's going on right now. For the last 30 years, Japan has been in deflation. Now, if you look at the statistics for Japan for the last 30 years, everything's kind of more or less gone down. Wages have gone down, prices have gone down. If you look at real estate prices have gone down. What's most interesting is real estate prices have consistently gone down over that period, in a similar way that they would go up in inflationary periods. But if you think about, real estate as an investment, you get tenants, they're paying rent, right? They're paying you rent every month. Well, in deflation, they can afford less over time, right? So your $1,000 a month in rent maybe goes down to $950 a month and goes down to $900. So that is going down too, because that's all people can afford. That's what the market rate's is gonna be over that time. So that's gonna go down. So your rent's gonna go down, but your real estate value is gonna go down, but your price that you have on your mortgage is not gonna change. So it basically reverts the benefits of real estate. Now, real estate's not a bad thing. If you don't have a mortgage, it's fine. It's still producing cash flow. You're still getting a lot of the tax benefits. There's a lot of good reasons to own real estate. The point I'm making is that you have to understand the dynamics of what works well in inflation versus deflation. So cash works well in deflation. Leveraged assets do not work well because of the principle I was talking about. And anything that's higher risk tends to do less well. As I said, gold can do well depending on what's going on. Safe bonds. Other things that don't do well they tend to be equities, although it depends on the equity, but we don't get these bull markets like we're getting here. So what's really important to understand is deflation, there's a lot of things that really aren't great for deflation. It might be good for the net consumer, assuming that your wages are still flat, like they have been for the last 20 years. But you're looking at Japan. If you really want to look at an example of deflation, just study Japan. We actually have a bunch of good articles on our website that talk about Japan and deflation and what's going on there. And I think if you just look at that, you get a really good read for how deflation works. They're really one of the best examples right now. Europe is actually in stagnation. People can argue whether things are going well or not. I would argue Europe is in a stagnation kind of. I don't even know if you could call it deflation, but they're more of a stagnation thing going on. The U.S. is hard to tell what it's going to look like. Are we going to look like Europe, or are we going to look like Japan? I don't really know yet, because we tend to be a little bit more volatile with our markets. I think Europe is, they tend to be a little bit more flat. There's not as much innovation and growth as there is in the U.S. So you tend to get maybe less volatile spikes, but it just means, at best case, it means you're not making any progress. As a few economists have said, it's kind of like a muddle through economy where you're just kind of getting through it. That's kind of a best case scenario in a deflation. The problem is a lot of things in the system don't really get out of the system, because one of the problems with deflation is you're not allowing the system to self-correct. So if you think of all these banks that probably should have gone bankrupt in 2008, you think of all these companies right now that are going bankrupt because of COVID. Not saying they should go bankrupt, but there are a lot of companies that are actually probably should have gone bankrupt before COVID anyway. And, public companies and private aside, they were highly leveraged. They're barely making it. And COVID just kind of kicked them into the dustbin.
Now the guys behind you, the Federal Reserve, then came and bought up, their debt. Now about a third of all mortgages are owned by the Fed. The Fed even was buying, investment grade bonds, 10-1 or junk bonds at a rate of 7-1 leverage. And this was something that I pointed out in my Acapulco speech. Is listen, they usually have about 30% of bonds are going to go from BBB, the lowest grade of investment grade, to then junk status. And when that happens, all the ETFs are going to be forced to sell. And actually, I predicted on stage that the Fed was going to have to come in and then have to buy up those bonds, which was blasphemous, never happened before. And that's exactly what they had to come in and do, even to a point that surpassed my wildest expectations. And so you're creating these zombie companies, and I know I'm probably getting murdered in the comments here, because obviously a lot of people that follow me are heavy into gold, heavy into Bitcoin, obviously, are, think, and I just want to point out that you're not anti-gold. I mean, as a matter of fact, I think going back to 2008, you were trying to see if you could get paid in gold, because it was something that you wanted to, offer as an option. And, there is gold in our portfolio, and you're not anti-gold. You're just trying to, be agnostic and tell people like it is. And it almost seems like from an investment perspective, and obviously, past performance, no indication of future returns, but how we were invested. And for those of you who don't know, Kirk is the managing principal of Innovative Advisory Group, which is where I hang my hat out and shingle from. But from the main core strategy that we were employing for 2 years, it almost seems like it really didn't matter if we had inflation or deflation, because we were sort of protected for either one. But I do want to make the point that you're not anti-gold. You're not one of these people that is always poo-pooing it, but I guess you're also not to knock this person, but you're also not Peter Schiff either, that's always touting how it's always a great time. And I do think people should, at a bare minimum, have it as that chaos hedge that you were talking about, because I couldn't imagine a time where there's more potential for chaos, at least in the United States, than what we have now. But I don't know if that was more of a statement or a question.
No, it's look, you make a good point. I'm glad you bring it up, because I don't. I'm asset class agnostic. There are people, and I'm not going to name names, but there are people out there who are always, we call them gold bugs. They're always bullish in gold. It's always a good time to buy gold. Oh, great. It's going down. Great. You're getting it at a discount. Let's buy more of it. And I look at that and just say, that's just ridiculous. Like there is a time to own it, and there's a time not to own it. And there are people on the other side of the coin who say, oh, you're all tinfoil hat kooks if you're owning gold. Gold's ridiculous. You got Warren Buffett saying that it's a worthless asset. It doesn't produce any cash flow. I think
recently, though, he did come out and, well, not necessarily him, probably one of his underlings came out and bought, I forget, was it Barrick Gold? I think, I can't remember the exact gold company, but one of Berkshire now did invest, for them, probably a relatively small amount. I think it was like $500 million or something into gold, which was a departure from what, they had done, the past 70 years or however long they've been around.
Yeah, look, it's where I'm going with this is there are people out there who have a fixed mindset about gold. It's either very positive or very negative. And it's, from my standpoint, I look at stuff like that and I just say, that's ridiculous. You have to look at the facts, and you have to make up your mind based on the facts. There were times if you go way back to, basically the early 2000s, 2000 to 2000, and I think it was 11 was the peak. And that was right before it started. No, I'm sorry. I'm looking at the wrong chart here. So yeah, if you go all the way back to the early 2000s, and then the peak was around mid 2011. And then after that, it kind of came down. Then it really came down in 2013.
I mean, in 2000, I'm not looking at it, but it was around 300. And I think that's when Canada, infamously sold all their gold, right? Pretty much, I don't know if it's exactly 2000, but somewhere between there and 2003. I'm just doing this off memory right now. But yeah.
Where I'm going with this, though, is so you have these periods where gold is in favor, and then you have periods where they're not in favor. And it doesn't mean it's a bad asset. It just means that it's a bad price. And, there are lots of reasons to own gold. You can own, I know a lot of people, they own gold no matter what it's doing. And it's their chaos hedge. It's their hedge against inflation. They own it for specific reasons. A lot of really people own gold and they never sell it. They just sit on it. And that's okay. There's reasons for that. And there's nothing wrong with that. But if you're investing for, a trend, or if you're investing to make money, then you have to understand that there are peaks and there are valleys, and there are times to invest and there are times not to invest. So, we invested during the good periods in the early 2000s, and we got out for a while. And then it was really cheap, and we bought back in because it was actually under the price of what it takes to produce an ounce of gold. Well, that to me is kind of a nice floor. No matter what happens, it's going to be hard to go under that because you can't produce.
What do they call that?
I think it was
backwardation or something. I forgot what they call that.
No, that's the futures prices.
Okay.
No, that's future prices. What I'm talking about is, I think at the time it was about $1,250 an ounce is what it took to mine an ounce of gold, and it was trading for about $1,050 an ounce. Well, what that means is that no one's going to be producing gold because it costs too much, and you're going to get less than what you mine it for. So all the mines shut down. Well, if all the mines shut down, there's no more gold, which means the prices go back up. It's just supply and demand. That's how commodity prices work. And subsequently, that's what's happened. It's gone back up and down, and it's come back to a normal range. So my point is that was a great time to invest in gold and mining stocks if you could find good ones, because they were trading at a huge discount. Now gold's in favor and everybody wants to buy it. They should have been buying it a few years ago when it was cheap. And I'm not saying it's over, because I think it's still in a bull market. I think gold still is in a bull market and will be for a little while.
Especially the fact that, now we're pretty much, hanging out, give or take, at the previous high, and we've been doing so for, a while now. So I think that probably is a bullish signal that the resistance is now the, give or take, the previous high.
Yeah. Look, it's, no one knows the future, and I'm not going to sit here and say, gold is going to keep going up or it's going to keep going down, because no one really knows. But all the evidence points to the fact that gold is still in a bull market. And, based on what I'm seeing, I don't see that ending right now. I still see a lot of institutional money, a lot of investors putting money into gold, which means supply and demand, people want it, price goes up. So I think that's kind of inevitably that's going to continue, at least in the time frame. So I just want to point out that you have to be asset class agnostic. You might love your asset. You might be a real estate investor through and through, and it might be it's what you have a passion for, and that's great. But if we have a deflationary environment like Japan, you just need to understand the environment that you're in. It's not that real estate's bad. It's not like people don't own real estate in Japan. They do. You just need to understand how to own it. And if you're trying to leverage yourself up to the hilt, then you're just going to get burned. It's like these oil and gas wildcatters that take all this risk, and then a bear market hits and they get blown out and go bankrupt because they're not managing the risk. And what's really important, and this is what we do a lot of, is risk management. Is how do you manage your risk around an asset so that you can still make money during the good times, and during the bad times you're not losing.
But I think another important point is that, if people think all this money printing creates inflation and that gold would be a good hedge in that, and that then can create a self-fulfilling prophecy, especially given the fact that the gold market relative to, other financial assets is, pretty much like a drop in the bucket. We just saw the other day, we just topped $27 trillion in debt for the first time. But, to your point, a lot of this money is not really going out and being freely spent and going and circulating through the economy. It's basically being, there to keep some of these zombie banks alive. And so, at this point, I'm not sure if this is going to end up being a Money Tree episode, but we probably want to, kind of wrap things up. And so I know that people can find you at innovativewealth.com. They can find myself there also. But is there any, any other plugs you'd like to give, or anything else you'd like to touch on in inflation, deflation, as we start to wrap this up?
Yeah, look, if you're interested in hearing more about inflation, deflation, you can certainly go to our company website, innovativewealth.com. You can certainly find me on Money Tree Investing Podcast. I do that show every week. We have a lot of great guests. Tim's on occasionally as well. We bring him on to talk about some of the things he's passionate about. And, it's a great show. It's one of the longest running podcasts out there. And we have a lot of great guests. We brought on some pretty interesting ones in the past few years. So if you go back in the history, you'll be able to see them. So I would just say, that's really been our medium during this crisis, is just having these episodes every week and just bringing on good guests that can talk about, I'll give you a good example. We had a great interview with Rob Arnott, who, if you're not an institutional investor, you probably don't know who the heck that is. Rob is one of the most well-known institutional researchers, research affiliates. And he did a great paper on the pension crisis and what that means. So I saw that paper and I was like, this is exactly what I want to talk about, is people don't know what the pension crisis is. So he went over all the details, all the data, statistics. We got a YouTube video up there. Like, it was just great stuff. So my point is it's a great show. Come check it out. They can find that on iTunes and probably all the other, usual suspects for places where you can find podcasts under Money Tree Podcast. Is it moneytreepodcast.com? Is that your Yes, moneytreepodcast.com. You can find it. We're the only Money Tree investing podcast out there. So find it, there's a thing Google, you should be able to, but yeah, moneytreepodcast.com is the website.
Okay, and for those of you who are, seeing me for the first time, or maybe you're listening to this on World Alternative Media, I'd also, invite you guys to subscribe to my YouTube channel, Tim Picciott, the Liberty Advisor. You can find out more about basically all the platforms you can find me at. This will be launching soon, the libertyadvisorshow.com, where, I encourage people to go on other platforms just aside from YouTube. I'm going over to library, lbry.tv / the Liberty Advisor, and also on float.app / the Liberty Advisor. And, everything we do is also available on podcast format and all the usual suspects. Just type in my name, Tim Picciott, the Liberty Advisor. Probably Liberty Advisor would be enough to get you there. And then if you are interested in working with myself or Kirk, you can find out more at innovativewealth.com. And then if you want to specifically for, what I'm doing in the crypto space, you can find out more at thelibertyadvisor.com for the business side of things. But anyways, thank you, Kirk, for breaking down the inflation, deflation. I know it's not necessarily what people wanted to hear, and not necessarily creating, this, feedback of, all this, positive things of getting people what they want to hear, but I think is what people need to hear. And, on a long enough time horizon, who knows, I think eventually, things will end up collapsing on a long enough time horizon, but in a short enough time horizon, people do, go to the dollar in terms of crisis. They do things that, are a little bit counterintuitive. And, that's a message I've talked about for a while. But anyways, I definitely appreciate having you on the show today. It was, a wealth of information, and look forward to having you back in the future.
Yeah. Thanks for having me on, Tim. This is a lot of fun.
Yep. Thanks, Kirk.